Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note for the record that today's meeting is open to the public for in-person attendance as well as through a live webcast. For anyone watching online, if you would like to view the closed captioning of this meeting, please click on the CC icon located in the lower left-hand corner of your WebEx window. You may also choose the layout to one of your choosing by clicking the layout option on the top right side of your screen. Before we begin our formal agenda today, I want to highlight one recent agency action. Earlier this month, I signed NCUA Letter to Federal Credit Unions 22-FCU-03 entitled Expiration of Emergency Exemption from Certain In-Person Meeting Requirements. This letter notifies federal credit unions that virtual-only membership meetings will no longer be an option beginning on January 1st, 2023. The letter also reminds federal credit unions that they will have to have the continued flexibility to hold hybrid membership meetings, which may suit their budget needs better. The letter contains additional guidance for conducting federal credit union board meetings and the distribution of member notices. For anyone with questions, the letter is available on the NCUA's website. Now, turning to our agenda, the first item of business today is a board briefing on the Share Insurance Fund's normal operating level. Staff presenting, Amanda Parkhill, Deputy Director, Office of Examination and Insurance, David Blanchard, Risk Management Division Director, Office of Examination and Insurance, and Andy Leventis, Chief Economist. Good morning, Amanda, David, and Andy, and congratulations, Amanda, on your much-deserved promotion. You and the team may begin whenever you are ready.
Great, thank you. Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. I'm here with Andy and David this morning to brief the NCUA Board regarding the results of the normal operating level calculation. And I know everyone's eagerly anticipating to hear what the normal operating level will be, so we'll start with that. It will remain at 1.33%, which is what the board set it at last December. And just as a reminder, board action is only required when there's a change in the normal operating level. So Dave is going to talk about some of the normal operating level requirements, trends, and the policy, and then Andy will provide some detail on the methodology and the inputs we use to calculate the normal operating level. So with that, I will turn it over to David.
Okay. Next slide, please. First, I'd like to discuss the normal operating level for the Share Insurance Fund and how it relates to the Share Insurance Fund equity ratio. The normal operating level represents the desired equity ratio for the Share Insurance Fund, and it is a point beyond which excess equity is returned to the credit unions in the form of a distribution. Under the statute, the year-end equity ratio of the Share Insurance Fund exceeds the normal operating level, and any loans and associated interest to the fund from the federal government have been repaid, and the Share Insurance Fund's available asset ratio exceeds 1%, then the NCUA must return the excess to the credit unions. In addition, the Federal Credit Union Act requires the board to set the normal operating level to not less than 1.2% and not more than 1.5%. The board set the normal operating level at 1.33 in December 2021 after receiving comment from the industry on proposed changes in the 2017 board-approved methodology. Next slide, please. The equity in the Share Insurance Fund consists of the credit union industry's 1% capitalization deposit and cumulative retained earnings from investments, net of expenses, and losses from credit unions. As noted in the previous slide, the Federal Credit Union Act requires distribution of funds from the credit union industries if the equity in the Share Insurance Fund exceeds the normal operating level. There are a few additional statutory requirements. If the equity in the Share Insurance Fund falls below 1.3%, the NCUA board may assess a premium, but only enough to return the equity to the Share Insurance Fund back to 1.3%. Therefore, increases in equity above 1.3% can only occur through increases in retained earnings. If the equity in the Share Insurance Fund falls below 1.2%, the statutory minimum threshold, the NCUA board is required to implement a fund restoration plan to return the equity in the Share Insurance Fund to 1.2%. Next slide, please. This graph shows the historical trend over the past 8 years of the normal operating level in relation to the actual equity ratio and the statutory minimum equity level set by the Federal Credit Union Act. In 2017, the NCUA board closed the Corporate Credit Union Stabilization Fund and consolidated the assets and liabilities of the Stabilization Fund into the Share Insurance Fund. This resulted in an increase in the equity in the Share Insurance Fund and became the year-end equity ratio exceeded the normal operating level, and this allowed for a distribution of over $735 million to insured credit unions. In 2018, the NCUA board set the NOL at 1.38%. The equity ratio was 1.39% at the end of 2018, so the difference was also distributed in the second quarter of 2019, totaling $160.1 million. The NCUA board set the normal operating level at 1.38 in 2019, and it remained at that level through 2021. The board set the normal operating level at 1.33% in December 2021. The reduction in the NOL was mostly due to the removal of the corporate asset management estates and the NGNs from the calculation. Next slide, please. Based on the board-approved policy, there are three primary objectives in setting the NOL. Retain public confidence in federal share insurance, prevent impairment of the 1% contributed capital deposit, ensure the insurance fund can withstand a moderate recession without equity ratio declining below 1.2% over a 5-year period. The goal is to maintain a sufficient equity level in the insurance fund to avoid assessing a premium during economic downturns when the credit unions can least afford it. Next slide, please. The current NOL calculation is based on the modeled performance of the Share Insurance Fund over a 5-year period, assuming a moderate recession. The model assumes stress scenarios for the three primary drivers: insurance losses, insurance shared growth, yield on investments, and Andy will now walk through how the agency developed these assumptions.
Thank you very much. Next slide, please. So to estimate the effect of a moderate recession on the three primary drivers, the first step is to establish what the moderate recession looks like. To do this, as in the past, we have used scenarios from the Federal Reserve and scenarios that have been published in connection with its stress testing responsibilities. Each year, to facilitate bank stress testing required under the Dodd-Frank Act, the Fed publishes economic data describing a hypothetical severely adverse macroeconomic shock. This reflects a severe recession. The Fed also releases data describing a baseline scenario, which represents economically benign conditions. For our moderate recession, as in the past, we have taken the midpoint of the Fed's baseline and severely adverse scenarios. Next slide, please. So it's critical to note that the Fed scenarios were released last February, and thus it was necessary to shift forward the beginning of the hypothetical stress. For our purposes, it is also necessary to make macroeconomic assumptions over a longer time period, a 5-year horizon, rather than the Fed's 13-quarter window. To time shift the beginning of the stress and establish macroeconomic assumptions over the longer horizon, we use licensed data from macroeconomic advisors. The licensed data, which by construction remain consistent with the Fed's scenarios, were released in October and incorporate relatively recent macroeconomic trend data. The macroeconomic advisors' data assume that the stress period begins in the fourth quarter of 2022, and the stress window for our purposes begins in early 2023. So OCE needed to shift forward the macroeconomic advisor stress by one additional quarter. So ultimately, with all of these adjustments, they allow us to compute the equity ratio change over the 5-year interval between the fourth quarter of 2022 and the fourth quarter of 2027. At this point, I would note that the macroeconomic advisor scenario data include quarterly numbers, while in some cases our models employ annual metrics. In these cases, we simply average the relevant quarterly estimates to derive the annual numbers. Next slide, please. The graphs show how various macroeconomic indicators, unemployment rates, income growth, and the 7-year Treasury yield evolved during the stress period. In each graph, the dotted line reflects the adverse scenario, i.e., the moderate recession. that we've constructed. Also shown are the Fed's baseline and severely adverse scenarios, which of course were used to derive the moderate recession. The graphs show the contours of the hypothetical moderate recession. In the unemployment rate graph, for instance, you can see that the unemployment rate peaks at around 7%. Next slide, please. So having constructed the moderate recession, we then begin to estimate how the drivers of the equity ratio will evolve. For insurance losses, NCUA uses an econometric model to relate insured share losses to macroeconomic indicators. Model details can be found in the appendix that will be released to the public, but the basic modeling approach begins by estimating the historical relationship between macroeconomic indicators and the share of deposits at CAMEL's 4 or 5 rated institutions. Then, using the macroeconomic data for the moderate recession, we produce a preliminary estimate of annual losses using a benchmark loss rate. We then refine that estimate using a scaling or calibration factor. This factor modifies the preliminary estimate to account for any systematic differences between estimated losses and likely losses during the baseline scenario. In a sense, it ensures that the model estimates are well anchored to historical data and not biased upward or downward. Next slide, please. For estimating insured share growth during the moderate recession, we develop an econometric model, a simple least squares regression that relates quarterly share growth to unemployment, treasury rates, and seasonal factors. More than 17 years of data are employed in estimating these relationships. Coefficient estimates and other model information can be found in the appendix. Using the coefficient estimates coupled with the macroeconomic data for the moderate recession, we then estimate changes in share growth over the 5-year modeling interval. Next slide, please. So for the third and final driver of the equity ratio, yield on investments, no modeling is necessary. After time shifting the beginning of the moderate recession, as we've discussed, we simply report the interest rates reflected in the macroeconomic advisor's implementation of the Fed scenarios. The 3-month and 7-year Treasury rates are used to estimate SIF investment returns. Next slide, please. So this slide summarizes our final estimates for the key drivers of the equity ratio over the projection period. The highlighted cells show the estimates under the moderate recession, i.e. the adverse scenario. Values are also shown for the baseline and severely adverse scenarios for context. Estimates are shown for each half-year period. So, for instance, you can see that during the first half of 2023, the insured share losses were projected to be around $73 million. Growth rates are shown for half years and are not annualized. So, for instance, you can see that the projected growth rate for insured shares is 5.2% for the first half of the hypothetical moderate recession beginning in the beginning of 2023. Looking at the table and comparing the various scenarios for insurance losses, you can see that, as you would expect, share growth and cumulative losses are elevated during the moderate recession and would be even higher during the severely adverse scenario. Meanwhile, interest rates drop during the hypothetical recession, as would be consistent with the onset of economic stress. The 3-month and 7-year Treasury rates, for instance, fall to around 2% during the first year of the hypothetical moderate recession. So at this stage, I'll pass the baton back to David, but before doing so, I'd like to note that, as I indicated before, more details surrounding our overall methodology will be posted on the website.
Next slide, please. This graph shows the impact of equity in the insurance fund based on modeled recession over the next 5 years. NCUA uses the adverse scenario to depict the modeled decline in the equity ratio over the 5-year period to determine at the necessary normal operating level to support the modeled decline. As you can see, in the adverse scenario, the equity ratio declines 0.139% over the 5 years. Next slide, please. The normal operating the normal operating level calculates to 1.339%, which could round to 1.34%. The board has elected to maintain the normal operating level at 1.33%, as it was set in 2021. As presented in September, the projected year-end ratio is 1.30%. So retaining the normal operating level at the 1.33% will not materially impact the fund's position. Next slide, please. The normal operating level model is used to determine the equity needed to withstand a moderate recession, but there are various factors that can affect this outcome. For example, extraordinary losses and/or failures in credit unions that are not market-related examples would be from fraud or other asset bubbles. Could be from unusual or abnormally high insured share growth material, which would be material different from historical correlation, and it could materially change the results of the model. Next slide, please. Following the board briefing, the next steps would be to update the public website with the materials that show the assumptions used to calculate the current normal operating level, make public the general parameters used to calculate the equity ratio decline in a 5-year moderate recession. This additional transparency fulfills the commitment NCUA made to the public as part of the 2022 annual performance plan. NCUA will calculate the actual equity ratio as of December 31st, 2022, and this is typically presented to the board along with the CIF quarterly update in February 2023. Should the equity ratio be above the normal operating level, the board must distribute the amount of equity above the normal operating level to the credit union industry. The official equity ratio on June 30, 2022 was 1.26%. The projected equity ratio for December 31st, 2022 is 1.30%. Next slide, please. This concludes our briefing, and we are happy to answer any questions you might have.
Thank you so much, David, Amanda, and Andy, for your briefing on the normal operating level. Your observations underscore the importance of maintaining a strong national credit union share insurance fund. Thank you as well for developing the additional analysis that explains in more detail your recommendation for the normal operating level. In the 2022 annual performance plan, as you noted, David, the NCUA board committed to providing stakeholders with more information about the factors used in setting the share insurance fund's normal operating level. Your analysis meets that performance goal and provides a high level of detail and an explanatory data to accompany it. Thank you for this additional transparency. With $20.2 billion in assets, the Share Insurance Fund currently shields 4 in 10 Americans who use federally insured credit unions. The Share Insurance Fund guarantees more than just their accounts or balances on a spreadsheet. It protects the financial well-being and dreams of families, businesses, and communities who've entrusted their hard-earned savings in federally insured credit unions. The Share Insurance Fund is also a critical bulwark that helps to maintain the economic and financial stability of our nation. Last year, the NCUA board prudently approved setting the Share Insurance Fund's normal operating level at 1.33% for 2022. That sound decision has provided the Share Insurance Fund with a cushion of additional reserves to safeguard the system as we navigated through many challenges over the last year. For example, there were supply chain disruptions and labor shortages related to the pandemic. Additionally, Russia's unjust war in Ukraine disrupted global food supplies and energy markets. We also saw inflation rise to the highest level in decades, and consumer confidence weakened as households took on more debt. Nevertheless, the unemployment rate remained low and wage growth stayed strong. In terms of overall performance, federally insured credit unions remained on a solid footing during 2022. Total loans, assets, and insured shares and deposits all increased. Yet some cracks have started to form around the system's edges and within some credit unions. In the year ahead, we need to ensure that these small fissures do not grow into sizable fault lines. In last month's Share Insurance Fund report, we learned of an increase in the number of credit unions with a composite CAMELS code 345 code rating during the third quarter. Several credit unions have also recently experienced liquidity issues, including some with more than $1 billion in assets. And with ongoing inflationary pressures and continued interest rate increases likely, the potential for headwinds slowing the economy and increasing stress on both households and financial institutions alike continues to grow. One of the most important responsibilities of the NCUA board is maintaining the health and stability of the Share Insurance Fund. Indeed, David, as you noted on slide 5, the board's policy calls for setting the normal operating level at a level sufficient to retain public confidence in federal share insurance, prevent the impairment of the 1% contributed capital deposit, and ensure the Share Insurance Fund can withstand a moderate recession without the equity ratio declining below the 1.20% over a 5-year period. Given the level of economic uncertainty in the year ahead and the growing stresses we see within the credit union system, the staff's recommendation to maintain the normal operating level at 1.33% in 2023 is sound. As detailed on slide 15 of the presentation, we could have opted to round the normal operating level up to 1.34% based on a December 2022 estimate of 1.339%. But because this figure was just a half of a basis point difference from the actual normal operating level for December 2021, we've decided to maintain the current level. I am supportive of this recommendation because the board will continue to monitor the potential risks to the Share Insurance Fund and can reevaluate the normal operating level as emerging trends in the industry, the economy, and interest rate forecasts become clearer. Finally, before closing, I do have a few questions. Andy, my first question is for you. One of the most consistent long-term trends affecting the Share Insurance Fund has been the slow and steady decline in the equity ratio due to the ever ongoing growth in insured shares. Do you expect that trend to continue in the years ahead? And also, how did insured shares growth factor into your analysis?
Yeah, no, thank you for the question. So I would expect a long-term downward trend in the equity ratio to continue. The recent increases in interest rates certainly have been helpful. They've increased SIF investment returns. But on balance, I think we're still swimming against the tide. With some back-of-the-envelope calculations, you can easily see that without pretty sharp increases in interest rates or a dramatic slowdown in share growth, the equity ratio will continue to decline over the next few years. On the second question of share growth, as you know, there's a clear empirical phenomenon in which economic stress, like a moderate recession, tends to increase share growth. There's a flight to quality. Sure. So now, as we've talked about before and indeed experienced viscerally over the last couple of years, that share growth tends to drive down the equity ratio. So in the context of the NOL analysis, that means that in addition to insured share losses, elevated share growth tends to play a significant role in that 5-year decline over which we calculate the equity ratio.
Andy, let me just dive a little bit deeper. Credit unions are a victim of their own success, right, if you will, because of the increased shares coming into the system.
That's right.
At what point would interest rates need to be at a steady amount of time in order to accommodate that anticipated share growth? Where would we balance things out?
Yeah, so it all depends on what the actual share growth would wind up at. So, yeah, if you wound up if you said, okay, well, their insured share growth goes down to 1% a year or 2%, I think we still would need maybe 1 or 2 percentage points more in interest to basically not be swimming against the tide. Yeah. That's just my kind of mental guess at this point. But the point is, both factors, as well as, of course, insured share losses, all of that goes into determining kind of the, where the equity ratio drifts. But, if you just do back of the envelope calculations, make some assumptions about share growth, even if you drop share growth a fair bit, interest rates need to rise even more than they have for us not to be swimming against the tide.
Thanks, Andy. That's a great lead-in for my next question, which is about the economy. As we approach the new year, what is your sense of the economic outlook and interest rate forecast for 2023, and how will those two factors affect credit union performance And what does that all mean for the Share Insurance Fund?
Right, thanks. So most of the outlook for the next year is all about inflation and the Fed's response to inflation. The question is, will the Fed get inflation under control? And if so, will it be at the expense of causing a recession? Right now, the consensus seems to be that interest rates will rise a little bit further, and there will be an economic slowdown and perhaps a minor recession. And the expectation is also that inflation will subside by the end of next year to around 2%, which is the Fed's target. Now, all of that comes with a tremendous amount of uncertainty. Inflation could be much more than expected. Interest rates might need to rise more sharply to combat that inflation. The economic slowdown could be much more severe than being anticipated. All of this spells risks to credit unions. Inflationary pressures and economic deterioration have implications for loan performance, asset growth, liquidity. It's basically, risk to the overall system, to credit unions, and then of course the Share Insurance Fund. So ultimately, the insurance losses and the performance of the Share Insurance Fund are a function of all of these factors, and all of the factors have related risks at the moment.
And there are certainly other externalities like
Right.
fraud that could come into play.
Absolutely.
Auntie, I noticed that you took comfort in the consensus. There's always safety in numbers, whereas our former executive director, Mark Treichel, would talk about the wisdom of the crowd. What does your gut as an economist feel here for what's going to happen?
Yeah, that's a good question. My gut is that the Fed's increases in interest rates will probably bring down inflation pursuant to consistent with the expectation, the consensus expectation. But I think ultimately, there's a tremendous amount of risk in that guess. And the United States spent, 30 years between the mid 60s and the, early 90s, late 80s, basically combating inflation. And it's a hard cat to get back in the bag, so to speak. So even though my best guess would be that interest rates rise a little bit, unemployment rises a little bit because of the slowdown, I am worried that, we've just had a couple good inflation prints lately, and that's it. So you need many, many more in order for that cat to get back into the bag.
No, well said, and I certainly remember those high inflationary days myself, and it's something that we need to move quickly on to address. Thank you, Andy. Your comments illustrate the importance of credit unions staying focused on managing their interest rate, liquidity, and credit risks, among other things. My final question concerns the number of credit unions with a composite CAMEL codes 3, 4, or 5 rating. David or Amanda, should we anticipate that number to rise over the next year?
And I'll take that question. The current economic environment with the high inflation and rising interest rates have put pressure on the credit union balance sheets. We're beginning to see signs of stress on liquidity due to these factors. Considering the economic uncertainty that Andy just talked about, we could continue to see stress in these areas. Additionally, if the unemployment rate rises, this will result in increased delinquency and loan losses. When you combine these economic factors with the fact that we're returning to on-site examinations after several years of an off-site posture, it is possible that we will find issues that have gone unnoticed in a virtual environment. So yes, we anticipate there is reason to expect an increase in the number of CAMEL's 3, 4, and 5 credit unions.
Great. David, your answer illustrates why the NCUA board must continue to monitor the risk exposures of the Share Insurance Fund and the industry itself. And your answer helps to explain why we need to modestly increase the agency's budget in the year ahead, which the board will consider later today. Thank you again, David, Amanda, and Andy, for your very good work. That concludes my comments. I now recognize the Vice Chairman.
Thank you, Mr. Chairman. And thank you to Amanda, David, Andy for the briefing. You did a great job describing what it is we're talking about here at the NOL, so I'm going to skip ahead in my remarks a little bit and just note that we at the board have the discretion to assess a premium on credit unions when the equity ratio falls below 1.3, but that premium, Congress says, is only to bring it back up to 1.3, okay? Now, 1.33 NOL represents the point in which the fund is required to return funds back to credit unions. Now, a few months ago, I voted along with the rest of the board to lower the NOL from 1.38 to 1.33, where it had been at 1.38 for several years. We voted to lower it to 1.33. Now, I don't pretend to know that 1.33 is the magic, perfect net operating level. I do know that for the moment, moving it from 1.38 down to 1.33 like we did is a moot point, because we're not close to either number. And if someday we wind up back in that range, worrying about whether or not 1.33 or 1.38 is the correct NOL level, that will be a high-class problem to have. So given the current rate environment, I don't think we think we're in any situation where we're going to have to worry whether or not 1.33 was the right level. That said, every basis point over 1.30 represents money credit unions could put to good use. I appreciate the additional info on how the operating level is calculated. This type of transparency is exactly what agencies should do. I should acknowledge, I think we should acknowledge that it's our responsibility to show why 1.30 is not adequate. Again, every basis point over that, credit unions could use. Doesn't mean we don't have justification, but it's our responsibility to tell them why we're keeping their money. It's worth emphasizing here that credit unions are doing their part. I would like us to recognize this fact via finding ways to factor actual losses incurred into our loan loss reserves calculation. After all, the higher the loss reserves, the lower the equity ratio. More importantly, the actual losses incurred year over year may be a decent predictor of the fund's reserve needs. But of course, I acknowledge that insurance isn't about normal circumstances. The whole point of insurance is for the unexpected, the unusual, the chaotic. One additional factor in determining the adequate level of the fund's equity level is how well we manage our budget. Coincidentally, the budget is also on today's agenda. The cost of managing the risk in the fund, that's our budget, directly impacts the equity ratio. The more NCUA spends on itself, the lower the equity ratio. NCUA can't, in good conscience, spend additional millions of dollars on programming for ourselves, the 1,400 NCUA employees, while also claiming the insurance fund needs more cash. It's like, if you had a family member that came to you and said, I need some money, times are tough, okay. You gave them money, and then the next day you saw them in a new Porsche. Hey, buy a Porsche if you want, but don't tell me you're hard up, right? Anyway, I realize today's briefing is not about the budget. It's strictly about the net operating level calculation, but I hope you're picking up what I'm putting down. Lastly, I'd like to recall our meeting earlier last year, 2021. This was right after the second COVID stimulus bill was passed. At the time, the NOL had dropped considerably. I'm sorry, the equity ratio had dropped considerably due to all that cash flooding the country. And it created billions in deposits that NCUA had to insure. Our other problem back then was how little we were earning on our investments because Treasury yields were so low. At that meeting, almost 2 years ago, I suggested that one of those problems might help fix the other. What I said was all that stimulus spending, the juiced up unemployment benefits, the stimulus checks, et cetera, all that spending, because it was entirely deficit financed, meaning all that spending was the money the government borrowed, that spending should push Treasury yields higher. Thus, our new investments, at least, would start earning higher interest rates. Just want to note, that is in fact what happened. Now, the real world doesn't always immediately follow textbook economics, but the laws of economics eventually prevail, since economics is like physics. For every action, there is an equal and opposite reaction. I also understand why people make fun of us economics types for always saying, you know, on the one hand, there's this, but on the other hand, that's why President Truman said, find me a one-handed economist. So thank you, Mr. Chairman. That concludes my remarks, but I have a couple questions. Whoever wants to take this. You guys indicated that in a hypothetical moderate recession, losses would be about $540 million over 5 years. How does that compare to what we estimated last year?
So I'll take that. So last year's 5-year aggregate estimate of insurance losses was around $820 million. So it's down fairly significantly from last year. Now, for what it's worth, I would note that the decrease is largely a decline in the modest insurance losses we've seen over the last couple of years. So you recall I talked about a calibration factor. Well, that calibration factor is adjusting the preliminary estimates of insurance losses down even further, thanks to the fact that in the real world, actual insurance losses have been quite low. So we had a $820 million over 5 years last year. It's now down to $540 million or so, and that's over a 5-year window.
Gotcha. Can you point to a time, let's say, where 1.30 net operating level, let's say, can you point to a time when that was not sufficient? And what did we do to make up the difference?
And I'll take that question. So yes, in 2009, as a result of the failure of the 5 corporate credit unions, the equity ratio would have fallen not just below 1.20% minimum threshold, but would have fallen below 1%. It would have required an immediate impairment of a portion of the credit union's contributed capital. And in order to avoid this, the NCUA requested assistance from Congress, which resulted in a creation of the Corporate Credit Union Stabilization Fund. And this stabilization fund accrued the losses from the failed corporate credit unions and allowed NCUA to assess insured credit unions for their losses over time. This prevented the insured credit unions from bearing significant burden for losses associated with the failure of the 5 corporate credit unions within a very short period. For a hypothetical example, as we saw in slide 4, the equity ratio fell below 11 basis points between 2017 and 2019, from 1.46% to 1.35%. Had the normal operating level been set at 1.30% in 2017, it would have fallen to 1.19% in 2019, all else being equal. And that concludes my answer.
I appreciate that. I enjoyed the back and forth there about, trying to, where the economy may go. I know it's hard to do. What do they say? Predictions are difficult, especially about the future.
That's right.
Since the Great Depression, as I understand it, the 2 nastiest economic downturns we've ever had were the early 80s, Fed Chair Volcker trying to crush inflation, and then obviously the other one was the 2008-9 financial crisis, and that was not about crushing inflation.
Right.
I just want to say, just as an insurer, to the public, you're severely adverse, right? Which looks about like a 1982, 2008-9, right? 10% unemployment.
Right.
You got 7-year yields of 0.6, et cetera. Now, those of us who, sort of bond market people, we maybe overly credit Treasury yields. What they said, the bond market's predicted 9 of the last 5 recessions.
Right, right.
I think it was the president's chief of staff, Rahm Emanuel, said, man, I want to come back as the bond market. Then I know everything, But in that severe one, your 5-year losses were about $850 million.
That sounds right.
Yeah, I think it was 846,
Yeah. Okay,
something like that.
got it.
And that's a nasty one, right? That is 1982, red lines, real bad. If that happened and all that money was gone and we had to pay it out, just to review, that's 4 cents on the dollar of what we have. Now, we'd have to raise money, we might have to have premium, we would be below our net operating level in that scenario, I get it. But just as an insurer, people out there wondering how safe is my insurance?
Right.
Nasty recession, 5-year losses,
Right.
we'd still be sitting there with 96 out of $100 in the fund. Is that correct?
That sounds right. I don't know the math in front of me, but that does, ultimately 800 and some million dollars, although painful, would not destroy the SIF in any way.
Yeah, we have about 20 billion,
Yeah.
800 something million, it's a little over 4%. And just on inflation, just want to ask your opinion on this. When you're fighting inflation, obviously inflation is bad. It's a deterioration of your currency and your buying power. And people don't like paying high prices. It's hard to put food on the table, make rent, et cetera. But to crush inflation, and one reason a Fed chair, you can have a legacy as someone who caused a recession. That doesn't, Paul Volcker is very highly regarded.
Right.
And that was a brutal recession. You cannot have a good legacy as a central banker allowing inflation to get out of control.
Right.
And one of the reasons you want to crush inflation is not just to bring prices down at the grocery store and stop rent increases and all that. The other costs to perceived high inflation, the other costs to knowing that our central bank has a target of 2%. And when you're above it consistently, what's the one thing you know? We can't hit our target. You know that. Do you agree, any of you can take this, that the other reason to crush inflation It's not just to lower prices now, and that's important. It's the long-term risk of people investing in the US dollar and in the United States. Once you know you're investing in a country and a currency that has erratic inflation, that can't predict it, that's well above it, that tries to put it down and has trouble doing it, that when I worked in sovereign debt bond markets, bond markets are all about, is somebody going to pay me back the money? One thing we didn't have a problem with in treasuries was inflation risk and currency risk. That was generally not a big topic, right? It is in a lot of countries.
Right.
So, anytime you borrow money for a period of time, it's, is the person going to pay me back? That's credit risk.
Yep.
There's interest rate risk. There's a number of things. But at least with treasuries, we didn't really think too much about currency risk, right?
Right.
I have no doubt, that somebody might, if they owe me 1 million Argentine pesos in 10 years, are they going to pay me back? The other question is, how much are 1 million Argentine pesos going to be worth? And remember, inflation, Argentina, again, is one of those countries which we don't ever want to be.
Right.
Inflation is so high, in Argentina, they have siesta and they break in the afternoon. They raise the prices in the afternoon. That's how, at the store, that's how high inflation is. Do you agree that one of the costs of persistently high inflation and being known as a country and a currency that has it is not just the high prices, but the long-term disincentive to invest in the United States?
Yes, that absolutely would be true. I mean, there's multiple problems with inflation, but that would certainly be one of them.
I only mentioned it. I know that was a bit lengthy what I
No,
said.
no, I got you.
Yeah, it's something I think that gets lost because we understand it'll be focused on, wow, groceries are expensive. I get that. But countries that have a currency where the central bank does not control the inflation, your hurdle rate to invest in them goes way up and people start putting money elsewhere. So I just want to mention that one because I think it's missed sometimes in the obvious focus on immediate prices. That concludes my remarks. Back to Chairman Arbor.
Thank you so much, Mr. Vice Chairman. Your line about Harry S. Truman is one of my favorites. And I also think that there's another Truman quote on which we can agree, and that is the buck stops here.
That's right.
In fact, that sign is on my desk as a reminder to me on a daily basis about what we do here on the board. Board Member Hood, please proceed.
Great. Thank you, Mr. Chairman. And before I begin, I want to recognize our guest that's visiting here, a part of the African delegation. So welcome. We're delighted that you're here. We're so thrilled to work in partnership with so many of our credit unions in the SACOs there in your country. So we're thrilled that you're with us today. Now, for the issue at hand, thank you, Amanda. Thank you, David. And thank you so very much, Andy, for your presentation this morning. I want to begin by just noting that last year, because of the pandemic, among other factors, I called on setting the normal operating level at 1.30, at least temporarily. When I called on lowering the NOL, I did so because it became clear to me that the NOL was too high because the taxi medallion crisis is behind us and any risk from the closure of the temporary corporate stabilization fund have generally ceased. From 1984 until roughly 2017, the normal operating level set by the NCUA board was 1.30. It stayed in the 1.30 range during times of conflict and in times of relative calm through economic booms and busts and through societal and technological changes. It stayed that way again until 2017, when I believe the agency was worried about the failure of credit unions heavily concentrated in taxi medallion loans, and quite rightfully so. I'll note that when the NOL increase was done in 2017, the board at the time indicated the increase, and I quote from the remarks at the board meeting, was intended to be temporary. I now want to pose what I realize is a hypothetical question. For every basis point increase in the NOL, how much does that have the potential to take away from credit unions and ultimately their member owners in the form of a potential dividend based on this current point in time, assuming hypothetically that we are in fact required to pay a dividend?
And I'll take that question. Assuming insured shares remain static, a 1 basis point change in the equity ratio equates to about 170 million in retained earnings. And that concludes my answer.
Great, thank you. Having an NOL above 1.30 negates a lot of the benefit that credit unions receive by perpetually underwriting the 1% capital commitment to the National Credit Union Share Insurance Fund. I do have a few quick questions. How does a high loss reserve balance impact the equity ratio?
So the reserve balance, the equity ratio, through the cumulative results of the operations, including the numerator of the equity ratio calculation So increasing the loss reserve balance results in an expense to the fund, which lowers the equity ratio, all else being equal.
Very well, thank you. What do we currently have estimated in our loss reserve balance?
The loss reserve balance is about 183.2 million. And that consists of 171.9 million in general reserves and about 6.3 million in specific reserves.
I've just been told that I'm muted. So I've been told I'm muted. Can anyone hear any of my remarks, or should I begin at the beginning? Little joke, little regulatory.
No, it's good. Skip to the end.
How much was lost in the high water mark of losses for the fund with the taxi medallion crisis?
So with the total losses of the failure of 4 taxi medallion credit unions, it equated to about $840.7 million.
Very well, thank you. 5 years ago, what did we estimate losses would be over a 5-year period, and what were the actual losses?
So I'll take that. So in answering that, I would note that these aren't forecasts. These are scenarios, and we publish a moderate recession scenario, and then we have a baseline and severely adverse scenario. And of course, by construction, the baseline scenario estimates losses using the 5-year historical loss rate. So given all of that, if you go back 5 years and you look at the baseline scenario, which again wasn't a forecast, but if you look at that, you'll see that estimated annual losses over the next 5 years were in the range of 50 to 80 million. In the years since, for context, actual losses, excluding Melrose, were in the range of 1 to 187 million, with the average being around 51 million. So I would, just as an aside, note that when we did the 2017 NOL and estimated the impact of a moderate recession on the equity ratio, the estimate was 13 basis points, which is not far from where our estimate is this year.
Great, thank you, Andy. Following on with that,
Yep.
have we overestimated or underestimated losses over the time frame in the National Credit Union Share Insurance Fund under the NOL model?
So so these aren't forecasts, but by construction, when we do the baseline scenario, we look at the 5-year average losses to estimate annual losses. Well, we take the 5-year average losses and we apply those going forward. So in one of the last 5 years, the actual annual losses were above the prior 5 years' losses. So, of course, I would mention that it's tough to know what losses would have been over the last couple years, but for $5 trillion and or actually more in extraordinary fiscal stimulus. So, but for that extraordinary intervention, or even under a much more modest response, that the losses could have been much higher.
Great, thank you, Andy. And while I understand that this is just a forecast, like even today's weather forecast, we should, and in fact, we do use this information to improve our model, and I think that's something that's ongoing.
Yep.
Wrapping up, just a few more questions. In February 2023, do we think the equity ratio would be at least over 1.30?
And I'll take that. The NCUA projected the equity ratio for December 31st, 2022 to be 1.30%.
Thank you. And how many times since the inception of the fund have we assessed premiums?
For the Share Insurance Fund alone, the NCUA has assessed premiums 3 times, one in 1991, one in 2009, and one in 2010. This does not include years when premiums were assessed for corporate credit union stabilization fund expenses. NCUA assessed a $165 million premium in 1991, a $727.5 million premium in 2009, and a $930 million premium in 2010.
Very well, thank you. And finally, for next year, do we expect any type of share growth? And any one of you can take that question.
Yeah, I think it would be extraordinary not to have share growth, and even though we've had excessive share growth over the last couple of years, and it is expected to fall pretty sharply relative to where we've been the last couple of years, it would be an extraordinary year to have no share growth.
Great, thank you, Andy. And here's my thinking, though, everyone. If 1.30 is not adequate, and I certainly agree with the Vice Chairman on this, I think the burden of proof then should be on the NCUA to show this figure is inadequate. While I believe you can easily make the case to have the NOL set at 1.30, I do think we have been more transparent this year in how we arrived at 1.33. So for that, I certainly applaud all of your efforts. Given the economic uncertainty that we currently face and the need to potentially avoid a hypothetical premium in a recession, I can understand the 1.33 suggestion, but it's not my preference. However, I will accept today's recommendation given the views of my board members that have already been enunciated. So thank you all for your time and hard work on this issue. That concludes my remarks, Mr. Chairman, now that I think I'm still audible.
You are indeed audible. And in fact, if you were an audible in my car, I would listen to you too. Thank you, everyone. That concludes our discussion on the Share Insurance Fund's normal operating level. The second item on our agenda today is the NCUA's budget for 2023 and 2024. Staff presenting are Eugene Sheed, Chief Financial Officer, and Jim Holm, Supervisory Budget Analyst, Office of the Chief Financial Officer. Eugene, Jim, always good to see you here at the table. Please begin when you're ready.
Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. I'm Eugene Sheed, the NCUA's Chief Financial Officer, here with Jim Holm to present for your consideration this morning the recommended agency budget for 2023 and 2024. As required by statute, the staff draft budget was posted to the NCUA website on September 29th, 2022, and then also published in the Federal Register. The NCUA held a public meeting on October 19th to present the draft budget and to receive public comment. 4 associations presented their views at that meeting on the draft budget, and subsequently, the NCUA also received 4 additional written statements from additional organizations for a total of 8 comments. All written submissions were posted on the regulations.gov website. I will present this morning an overview of the recommended changes to the draft budget, and Jim will discuss the public comments, the overhead transfer rate, and the operating fee schedule for 2023. The 2023 recommended total budget is $360.4 million. That will support 1,214 positions, and this is lower than the staff draft budget by $6.6 million and 7 positions net. This overall funding level is 6.2% higher than the 2022 budget level, but 1.9 percentage points lower than the 8.1% annual growth that was presented in the draft. The recommended total budget includes reductions of $6.7 million for the operating budget and a small net increase of $47,000 to the capital budget and a small increase of $50,000 to the Share Insurance Fund administrative budget. The recommended budget also includes carryover of $24.2 million in unspent prior year budget funds for both the operating and capital budgets. The 2024 budgets are projected to increase over 2023 by $42.8 million. And I will note $24.2 million of that increase is the result of the use of the carryover funds I just mentioned to help offset the 2023 budget that would then not be available again in 2024. The recommended 2023 operating fee collected from federal credit unions would also be reduced by $15 million in today's recommendation, which is the result of our review of the accumulated cash surplus in NCUA accounts that exceeds our projected funding needs for items previously approved by the board. The board action memorandum before you today includes a summary of budgetary tables for the operating, capital, and Share Insurance Fund administrative budgets, detailed budgetary tables for each NCUA office, an updated chart showing the distribution of the budget between amounts paid by federal and federally insured state-chartered credit unions, and an updated operating fee worksheet. The 2023-2024 budget justification will be updated to explain changes approved by the board and to respond to relevant comments from the public as Jim will discuss. The updated justification document for the final budget should be published on the NCUA's website when the updates are complete in January. Let me now summarize specific changes made to each of the draft operating, capital, and share insurance fund administrative budgets. First, specific changes to from the staff draft to the operating budget include 2 positions were added to the Office of the Executive Director to support the Financial Technology and Access team. The new staff will work with credit unions to harness the opportunities that innovation provides to support financial inclusion efforts and to make financial services more accessible to underserved communities. The Financial Technology and Access team can also work to increase the capabilities of the virtual exam program. 3 specialist examiner positions were deferred from the 2023 budget, 1 from each of the regions. 6 total positions were eliminated from the following offices: Office of the Ombudsman, Office of Examination and Insurance, Office of National Examination and Supervision, Office of Minority and Women Inclusion, and the Office of Credit Union Resource and Expansion. The budget for employee salaries and benefits was increased slightly by $162,000 net, reflecting the updated estimates for compensation for existing staff, offset by the reductions of the staffing levels I just mentioned. The budget for travel expenses was reassessed, and the recommended final budget reduces travel by $1 million as compared to the staff draft. The travel budget for 2023 would support approximately 70% level of the pre-pandemic travel. Contract support for the virtual examinations project was deferred to 2024, reducing the 2023 budget by $500,000. And support contract funding for information technology, facilities, and human resource projects was lowered by $623,000 net. The budget for fees that the NCUA pays to the Federal Financial Institutions Examination Council, or FFIEC, was increased by $615,000 based on the final estimate for the NCUA's contributions that was provided to us by the FFIEC after the staff draft budget was published. Finally, the budget updates the estimated budget surplus anticipated at the end of 2022 by an additional $5.2 million in the operating budget. The staff draft assumed $18 million in surplus for 2022. The revised total is now $23.2 million, which is used to lower the overall level of new operating budget funding recommended for 2023. Some additional non-material adjustments were made to funding levels in the staff draft operating budget for technical corrections and to reflect updates to information that was not available at the time the draft was published. Now let me turn to the capital budget. The recommended final 2023 capital budget is $47,000 higher net than the staff draft. Included within this amount is an additional $547,000 for performance enhancements to the merit examination system and an additional $500,000 for the cost of relocating the NCUA's disaster recovery site to a new location. The amount is offset by $1 million in surplus capital funding that was identified after reviewing the status of prior year's capital budgets. The recommended final 2024 capital budget is unchanged from the staff draft. The recommended 2023 and 2024 share insurance fund administrative budgets are higher than the staff draft by $50,000 in each year due to a re-estimate of administrative expenses. Let me now ask Jim Holm to explain how we use the comments from the public to improve our final budget recommendation.
Thank you, Eugene, and good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. As Eugene mentioned, the NCUA is required by law to hold a public hearing about the staff draft budget and to collect comments from other interested parties. At the budget briefing, representatives from 4 different associations presented their views, and the NCUA received written statements from 4 separate organizations that did not make presentations. Let me now provide you a brief explanation of how the recommended final budget responds to the public comments about budgetary matters. Staff in the CFO's office will refer more general comments related to NCUA's programs and operations to the relevant offices for their consideration. 7 commenters criticized the 9.6% annual growth rate for the staff draft 2023 operating budget. As Eugene summarized, the staff draft was reassessed, and the recommended final 2023 operating budget is $344.2 million, or $6.7 million less than the staff draft. These changes are largely driven by a reduction of 7 positions proposed in the staff draft, reductions to the staff draft contracts and travel budgets, and additional 2022 surplus funds identified by CFO staff. Overall, the recommended final budgets would increase by $20.9 million, or 6.2%, as compared to the budgets approved for 2022. As Eugene explained, this is 1.9 percentage points lower than the 8.1% annual growth proposed in the staff draft. This overall growth rate is also 6.1 percentage points lower than the 12.3% increase approved by the board for 2023 as part of last year's 2022-2023 budget. 5 commenters were concerned about the overall increase in NCUA staffing levels within the staff draft budget. Specifically, there was concern noted about the increase of 10 additional specialist examiners in the regions. As Eugene mentioned, the recommended final budget slows the implementation of the specialist program and delays hiring of 3 positions until 2024. 2 commenters recommended increasing eligibility for credit unions permitted to have an extended examination cycle from $1 billion in assets to either no asset limit or to at least $3 billion or to at least a $3 billion asset threshold, which would provide parity with banking regulators. We believe this comment is related to the budget because a wider application of extended examinations would result in a lower field staffing level. The final budget does not recommend this adjustment, given the risks that such a change would pose at this time. 4 commenters noted concerns related to the increase in budgeted travel funding in the staff draft. We reassessed the staff draft travel budget, and the final recommendation reduces travel funding to a level that will support 70% of the pre-pandemic travel activity. This is a decrease of $1 million, or 5%, compared to the staff draft. 3 commenters expressed concerns about how the NCUA's cybersecurity programs and budgets were explained in the staff draft, including 2 who noted how credit unions inherit risks from the cybersecurity practices at vendors upon which they rely. The 2023 staff draft did include a detailed explanation about the NCUA's cybersecurity efforts, and we will also include an updated version of that in the final budget justification. The agency's annual performance plan likewise includes outcome-focused performance indicators that illustrate the result of our agency's cybersecurity efforts. Additionally, at public meetings, the NCUA board receives periodic updates summarizing cybersecurity preparedness and emerging cybersecurity threats. While the NCUA has long recognized the potential risks associated with vendors' cybersecurity vulnerabilities, Congress has not authorized the agency to supervise or regulate vendors who provide critical systems and services to credit unions. 1 commenter requested additional justification for the increase in contracted services budgets in the 2023 staff draft, while a separate commenter expressed more general concerns about increases in all of the non-pay budgets. The recommended final budget reduces contracted services by $6.1 million net. This reduction is primarily the result of additional $5.2 million in projected 2022 operating budget surplus amounts identified within the CFO's review. Overall, the non-pay budget categories of the recommended final budgets are $6.5 million lower than the staff draft levels, including this additional 2022 surplus amount. 2 commenters expressed concerns about the costs presented in the staff draft for operating and maintaining merit. The recommended 2023 final budget includes $12 million to operate and maintain merit and to pay for the infrastructure costs associated with a nationally available system, such as cloud computing services costs, engineering support, and security functionality. The NCUA investment in this infrastructure, which makes up approximately half of the recommended $12 million operations and maintenance budget, is used in part to support other applications already deployed, as well as those under development. These infrastructure costs have previously been presented as related exclusively to merit because merit was developed simultaneously with this larger infrastructure project. In future budgets, the NCUA will distinguish the costs associated solely with merit operations and maintenance from the costs of infrastructure that supports multiple technology applications. One commenter urged the NCUA to evaluate its cash needs and provide a refund to credit unions in the amount of any surplus. As Eugene explained, the operating fee schedule reflects a credit of $15 million, which contributes to what would be an estimated 2023 operating fee reduction of approximately 1.8% compared to the 2022 fee level. This $15 million reduction to the operating fee lowers the amounts that will be invoiced to federal credit unions for the annual operating fee that's due on April 15th, 2023. One commenter questioned the NCUA's investments in contract support for various types of quantitative risk analyses, noting that credit unions themselves have also invested in analytic tools, such as for compliance with the current expected credit loss or CECL requirement. As discussed in the budget justification materials, NCUA strategic plans, and the agency's annual reports, the NCUA prioritizes robust analytic capabilities to help ensure the safety and soundness of the credit union system. Finally, one commenter requested additional details on the new Office of the Ombudsman and the role of this office within the NCUA. The Regal Act of 1994 requires that each federal banking regulator and the National Credit Union Administration Board establish an independent intra-agency appellate process. The duties of the Ombudsman are to act as a liaison between the agency and any affected person with respect to any problems such party may have in dealing with the agency resulting from the regulatory activities of the agency, and to ensure that safeguards exist to encourage complaints to come forward. Let me now provide a brief explanation about our final calculations of the 2023 overhead transfer rate, or OTR, and the 2023 operating fee. The NCUA's expenses are funded primarily through fees paid by federal credit unions and from transfers from the Share Insurance Fund using the OTR. As the annual budget is developed for board review and approval, the approved methodologies for calculating the OTR and operating fee are applied to determine the amount of the budget that will be financed by each. The board delegated authority to the CFO to administer the approved methodologies for calculating the operating fees and to set the fee schedule. The OTR estimates presented in the staff draft budget have not changed, and the final 2023 OTR is 62.4%. This is a decrease of 30 basis points from the rate calculated for the 2022 budget. The residual 37.6% of the 2023 budget will be collected through the operating fee. As shown in the attachment to the board action memorandum, in 2023, federal credit unions will cover approximately 68.7% of the costs of the NCUA's operations, while federally insured state chartered credit unions will pay approximately 31.3%. Worksheets that show the specific steps used to determine the operating fee and the scale for rates charged to different size federal credit unions are also included in the board action memorandum. Based on the current operating fee methodology, the operating fee charged to federal credit unions will decrease approximately 1.8% compared to 2022, which is a 17.2 percentage point reduction from the estimate provided in the staff draft. There are two reasons for the change to the operating fee. First, the operating and capital budgets were reduced by approximately $6.6 million compared to the amounts in the staff draft. Second, the recommendation includes a credit of $15 million in cash from the operating fund, representing prior year unspent operating fee cash collections that the NCUA does not currently require. Importantly, the OTR is billed throughout the year for actual expenses, so there are not any excess funds collected from the Share Insurance Fund that can be returned at the end of each year. Consumer federal credit unions with assets less than $1 million are not assessed an operating fee. For consumer federal credit unions with assets greater than $1 million, the NCUA establishes a three-tiered scale to compute the fee charged, which is also known as the assessment scale. The dividing points on the assessment scale are adjusted upward on an annual basis by the computed rate of asset growth. The dividing points are indexed annually by asset growth to preserve the same relative relationship of the scale to the applicable asset base. To illustrate the average rate impact for smaller consumer federal credit unions, the final operating fee for those reporting total assets under $2.26 billion will decrease from $167 per $1 million of assets in 2022 to $164 per $1 million of assets in 2023, a decrease of $3 per million, or approximately 1.8%. Consumer federal credit unions with assets between $2.26 billion and $6.84 billion would be assessed at a rate of $48 per million. And consumer credit unions with assets above $6.84 billion would be assessed at a rate of $16 per million in assets, both of which are also 1.8% lower than the rates assessed in 2022. That concludes our presentation today. Thank you very much for the time to present the budget, and we would be happy to answer any questions you may have about the final budget, the overhead transfer rate, or the operating fee.
Thank you so much, Jim. In the interest of time, I'm going to abbreviate my remarks today, but include the full statement in the record as prepared. Let me begin by thanking you, Eugene, Jim, and your entire team. I see at least one of them in the audience back there for developing and finalizing the recommended 2023 and 2024 budget. I know that you all have lost track of exactly how many hours that you have spent to get to today's final product, but thank you. Today's 2023-2024 budget agreement would not be possible without the collaboration of my fellow board members and their senior policy advisors, Sarah Bang and Lenwood Brooks. I'm also deeply grateful to the agency's chief of staff, Catherine Galicia. Together, they willingly engaged in good faith discussions about our individual priorities and helped us to reach consensus on the budget we are considering today. So thank you as well. There are also many individuals who contributed to today's final budget agreement, including the outstanding team in the Office of the Executive Director and every program office that participated in the NCUA's annual budgeting process. So thank you to all of them. As you noted, Eugene, the recommended 2023 budget, including the operating budget, the capital budget, and the Share Insurance Fund administrative budget, is $360.4 million and 1,214 positions. The total budget we are considering today is almost 2 percentage points lower than the staff draft budget released in October, and the number of new employees has decreased by 7. With respect to the budget itself, I'll note that 6.2% is much lower than 8.1% as we originally estimated, but also, too, it is a rate that is lower than inflation. So we are certainly working and striving to use our dollars wisely. As part of the approving the final 2023 budget, the board will also approve the $15 million credit against the 2023 operating fee, as Jim discussed. With this credit, the average fees paid by federal credit unions will decline by approximately 1.8%, the third consecutive year of declining fees. Of greatest importance to me in this budget is the addition of 2 new fair lending specialist positions as were previously proposed in the staff draft budget. Ensuring that credit unions are providing their members with safe, fair, and affordable financial products and services free of discrimination will lead to more wealth building in the communities that need it most. Moreover, I am very supportive of the budget's changes to in-field operations, including the creation of 2 new types of specialists, one for Bank Secrecy Act analysis and the other for consumer compliance. These are sensible changes to improve our operations and will allow us to supervise an increasingly complex credit union system. Finally, I do have just one question for you, Eugene, and it relates to the Financial Transparency Act, which is likely to be enacted into law before the end of the year as part of the National Defense Authorization Act. As I understand, credit union trade associations have championed this legislation. Would you give us an explanation about what that legislation will potentially cost the NCUA, both in terms of dollars and potential staff? And do we have an estimate on that point of how many additional employees we estimate will be needed to implement that law?
Okay, thank you, Chairman, for that question. So the budget, let me just say, the budget before you this morning does not include any resources for the implementation of the financial transparency provisions, as it was quite uncertain whether this would be enacted. My understanding of the provisions of this act is that it would have an effect on the resources of a number of NCUA offices, in particular the Office of the Chief Information Officer and also the Office of Examination and Insurance. I don't have a precise number at this time, but I believe the impacted offices, looking at the new requirements of the transparency provisions, have estimated that this could involve dozens of staff and contractors working on this over a multi-year effort, and costs that would be upwards of many millions of dollars. And so we'll assess that obviously going forward as a part of our mid-session budget, and since it's also a multi-year effort, how it could impact future years as well. Thank you.
No, thank you. And what I'm hearing from this is that while we've approved a 2024 budget, or I should say will approve a 2024 budget today, we already know that there may be additional resources that need to be added. I also understand that this legislation is going to require changes to the NCUA's call reports. I'm laying this out now because it is a potential cost that the NCUA will have to absorb beyond this year. It is also not part of the budget that we are approving today. While there are good policy objectives behind this data transparency initiative, everyone involved who supported this bill needs to know that these changes will incur costs as the NCUA works to implement the law. That concludes my comments. I look forward to a productive and successful 2023, and I now recognize the Vice Chairman.
Thank you, Mr. Chairman. Thank you to Eugene and Jim and the Office of CFO for your presentation and for getting us the draft budget early enough that we had that thoughtful public hearing. I want to thank the stakeholders who took the time to comment in person and in writing. I want to thank my fellow board members and NCUA management for their willingness to find common ground. So to state the obvious, with regards to NCUA and the 4,800 credit unions that we insure, every dollar in our little universe comes from credit union members. There's no other source of cash. There are only three places a dollar can live in this universe. First, most of it is at credit unions, helping America's credit union families. That's the most common place for the dollar to reside. The second thing that can happen to a dollar is that it's sent to NCUA and it goes into our share insurance fund, where it at least still belongs to credit unions, and it's sitting there available for use, invested in U.S. Treasuries. But the third thing that can happen to a dollar in this universe is that it's sent to NCUA but winds up being spent by NCUA in our budget. Those dollars are gone forever. Thus, our budget should always be created with the mindset that there are two other really great uses for any given dollar. I'm aware that next weekend, my son's Christmas presents are essentially paid for by credit union members, since that's who pays my salary. Any unnecessary spending on our budget is taking presents or food or clothes away from some credit union member out there. But I know our agency has necessary expenses. Regulation costs money, insurance costs money. And I'm happy that my NCUA colleagues will be taking great vacations this month or having enjoyable celebrations of various faiths and traditions. Prosperity is wonderful. I wish everybody had it. I will say that during the pandemic, when we were doing all virtual meetings, I was struck by how many NCUA employees were at their second home. And that's great for them. Hey, in this country, we celebrate success and abundance. But I think we all understand a bit why the general public looks at DC with something approaching disdain. So that's my general view on budgetary matters. Now, let's get to the specifics. The original draft budget we saw called for over a 12% increase in spending over last year. And we appreciate that the staff had revised that draft and called for 8.1%. I still think that was a little too much. Today, we're voting on a budget with a 6.2% growth rate, which is quite similar to what FDIC approved. I don't pretend to know the ideal budget number, but I do know that any agency budget is written by those receiving the money, not by those paying the money. Now, the budget is the price we charge for NCUA services. Now, our staff now argues that a 6.2% increase is on the low side. The credit unions are getting a pretty good deal here. That may be true. I'm not here to argue with that. Just want to say that in any discussion of the price of anything, you can be sure that those receiving the cash think it's a more reasonable price than those paying it. That's not NCUA, that's human nature. That said, I'm pleased that our personnel growth is prioritized to where the credit unions and agency need it most, closest to the credit unions, out there in the field. So the addition of regional staff, in particular our Bank Secrecy Act specialists, that reflects that priority. And I'll mention cybersecurity is a high priority for all of us. Now, I know that we can't be completely transparent with this due to confidentiality issues with cybersecurity, but I do ask that the board be briefed, let's say annually, on our cybersecurity investments and their effectiveness, and to the extent possible, make that information public. And last, we're going to go to Merit, and this is going to lead up into my question here, okay? Merit replaced the old software, and if you go back and look at the discussions about it, I can't remember, what year did this whole thing start, where we started Merit?
Boy, I'm looking at Kelly right now, and I believe it was around 2013, 14. It took us nearly a decade.
Yeah, okay. And if you look at what, it's supposed to be a lot better, let's say it is. When you pay top dollar for something, you should get something pretty cool. There's a place on this earth for steakhouses. There's a place on this earth for McDonald's. The market does not have any tolerance for McDonald's burgers and steakhouse prices. So you don't want to pay top dollar and get a mediocre product. We're still paying for Merit. It's way over budget. And I can say this, anybody from New England knows about the Big Dig in Boston. It was a massively over budget, wildly delayed government project whose sole purpose was to replace a prior wildly over budget, delayed government project, which is when Boston, like a lot of cities in the U.S., put massive elevated highways through old neighborhoods in the 60s and 70s. But I'll tell you this, it's finally done, and it's really great. The city is much, much, much better, right? You could argue with the original project, you could argue, but it's done, and it's really, really great. Whole neighborhoods have changed because of it. That's my question. Merit, we've paid a fortune. It's taken way longer. It's way over budget. Our annual costs on it. All right. Is it ever going to be, and Merit was decided and budgeted long before any of these three board members were on the board. Are we ever going to get there, like the Big Dig? Is it ever going to be, are we going to, this thing is top quality. It's really great. The costs that happened in the past, that's in the past. But is it ever going to be like the Big Dig, where, wow, this is really great. I'm so glad we did this. I know we spent too much money, but it's great. What do you think? I know you're not Merit experts, but we spend a fortune on it.
If I may just,
Sure, please do.
one thing that I was very taken with
Okay.
early on in the Merit process, as we were doing the prototype analysis, I went and met with a state regulator that oversees both credit unions and banks, and they use both banks system, that the OCC, FDIC, Fed have developed, and they use the NCUA system. And one thing that was very striking for me to hear is I was told the bank regulators and examiners were looking over the shoulders of the credit union examiners, and they were jealous of the analytics and the tools that we were building into that system. We're going to continue to refine Merit, and I'm certainly conscious of costs as we go ahead, but I think that is an illustration that we're leapfrogging above where our fellow regulators have been, and we're developing a state-of-the-art tool along the way.
You spend Ferrari money, it should be pretty cool.
You spent more
If
money?
you spend money on a Ferrari, yes, it's really cool. Yeah, of course it is. It's 300 grand. It should be really cool. All right, so I understand that. It is a quality product, but if you go back and look at how much it was supposed to cost to implement and the carrying costs, they are considerably higher than was originally planned, and it's absolutely crucial. But yes, it does do some very cool things. State regulators have some envy of it. I like that I like that for federal charters, for our examiners. We can put in Merit, was the exit interview recorded or not? That's a way to signal that it's a normal thing to do and expected. But anyway, Chairman Harper mentioned the quality of Merit, and again, I think it should be pretty cool given how expensive it was. Do you have any thoughts on how Merit is hitting the budget relative to what we thought a few years ago or going forward?
So I think as Jim explained a little bit, we've at times conflated some of what we referred to as the Merit application cost with some of the larger infrastructure costs that will eventually serve as a platform for other systems. So we will do a better job going forward to try and distinguish those. Initially, they were we had to build the infrastructure because Merit was first out of the gate with the infrastructure that we're operating on. The costs are higher than what if you look back to budgets the board approved several years ago. Yes, the costs are higher. I think as we work through it, though, you find that there are additional opportunities and functionality and improvements that can be made. So slightly different than a major infrastructure project where you build the project and then it's largely done. Something I think I've seen throughout the years with software development projects is you're continually finding additional opportunity and functionality. And so we've got to balance sort of that interest going forward with obviously the expenses of it. But I do think it has, leaps and bounds improvements over the systems that we were using in the past.
Thoughtful answer, Eugene, and you always give thoughtful answers, so I appreciate that. I'll stop with this one. So we're voting today on a 2-year budget. Can you just walk through what happens in year 2? Does the board reconsider the second year, 2024?
I'm sure I can take that question, sir. And that's right. I mean, you will pass a budget this year that provides, for the industry, for the public to understand, for our own offices to understand sort of on a planning basis what we think, the budget will look like in 2024. A lot's going to happen over the next year. You heard from the economists that, there's a lot of uncertainty about what's going to come next. And so it's obviously incumbent on all of us who work on the finances for the agency, as well as to inform you, sort of how the operations are going to change, what the changes in costs are going to be. And so we'll be back here next year presenting to you, also publishing in the register an updated 2024 budget. And that'll be, subject to debate, look at, sort of what our predictions were on a budgetary side of things are different from what we'll actually need at that time.
Thank you, sir. Back to Chairman Harper.
Thank you so much. And if you could, you did talk about cybersecurity briefings. We will be doing those on a semi-annual basis. And I should note that we have a study, 2 studies underway related to cybersecurity and administration. We may see cost changes there next year.
And I know we always have to balance the public information because you want to tell people, hey, there's a virus out there. Here's how a hack happened. But we don't want to teach anybody
Agreed.
How to do this hack. Oh, look, there's a vulnerability. So I get that. So go ahead.
No, absolutely. Board Member Hood.
Great, thank you, Mr. Chairman. I certainly want to thank all of our leaders who have helped prepare today's final budget. So special thanks to you, Eugene and Jim, for presenting. But I also know Melissa Loden worked on this along with a host of other folks throughout the agency. So thank you all for your hard work. I certainly enjoyed working in partnership with my fellow board members to devise and advance a budget that's transparent, expedient, and appropriate for our mission. We're already, however, seeing signs of stress. Liquidations and conservatorships are up, liquidity risk is rising, and we are facing uncertain economic headwinds. Because of this, I think it's important to emphasize the mission of the agency with the 2023 budget. So with this being my first question, what are the direct NCUA costs for the protection of the Share Insurance Fund and our industry?
Yes, sir, I can answer that question. In our detailed budget document, which, as Eugene mentioned, we will refresh and post on the website sometime early next year, we include a table that allocates the operating and capital budgets by the agency's strategic goals. And our strategic goal number 1 is ensuring a safe, sound, and viable system of cooperative credit that protects consumers. That would, include essentially the what you asked about, the protection of the SIF as well as the protection of the credit union system. Approximately 2/3 of those operating and capital budgets are allocated to strategic goal number 1, and then to that we would add the direct cost, the SIF admin budget, to come up with a total. So if you do that math, we'd estimate that approximately $240 million out of the $360 million is allocated to that part of our mission, the protection of the Share Insurance Fund and the protection of the credit union system.
Very well, thank you, Jim. You all, the final budget before us today is 6.2%. It's an increase year over year, which is, I think, a bit more reasonable than the 8.1% increase year over year that was proposed in the staff budget. I do have a few quick questions, but like you, Mr. Chairman, I will be submitting some of my comments for the record in the interest of time, since we do have a very lengthy agenda. Can you discuss the decrease in the operating fee, which we're considering, I guess, with the $15 million carryover?
Yes, certainly, sir.
So it's a decrease, but it's the 15 million. I'd like a little bit more explanation, please.
Sure, of course. So Each year, the CFO staff that's responsible for managing the spending side of the budget, once you all approve it, then we get to work spending it. We undergo like any business does, we undergo a cash flow analysis and try to look at, well, what are our spending rates through, in this case, last month through November. Also, how do we close out commitments and obligations that we made for contracted services and other activities during the year that are now completed? We can recover some of those funds, or even from prior years, the capital projects that take multiple years to complete. We're working on those on a monthly basis to make sure that once they're done, we close out the project, we recover any leftover funds, from the contract that we didn't spend. So that's the work that we do, all year long, but then culminating in figuring out what our cash position is so that we can inform the operating fee analysis. And in this case, we've identified that the $15 million is the amount of cash we have available that's not going to be necessary for our projected needs next year. So hypothetically, those funds could be distributed to credit unions, but it's just much more administratively straightforward to credit them on the operating fee. These are fees that have been paid in the past by federal credit unions, and so we're just essentially using those fees to lower what they would otherwise be paying when they submit their operating fee in April of next year.
Great, thank you, Jim. I know we've already had quite a bit of an extensive discussion this morning about merit. I was introduced to merit, I know, within weeks of coming to the agency, or returning, I should say, in 2019. So I was certainly impressed with it, and still am impressed because it is, you all, a reg tech solution. I really do think it is a 21st century tool that our regulators should in fact be using each and every day. I know the chairman mentioned that some of the states are looking over our shoulders when it comes to its implementation. I would counter with also some of the folks here in Washington as well, you all. We are the only agency that is really tackling innovation when it comes to using what I would call a reg tech or soup tech, supervisory technological advancement. So it's something that others are looking at from the other FIREA agencies. It's replacing that ARIES system that many of you know has been around for nearly 30, 40 years. So I do think that there will be some improvements, but I would like to know, though, can we reduce the cost in terms of the operations of merit? And when the initial board approved merit, can anyone discuss as to whether or not any discussion was had about maintenance cost?
Yes, sir. So, as Eugene explained, the merit costs really are split into not just the cost for operating and maintaining the system, but also for infrastructure, and the cost of supporting the infrastructure that goes along with, in this case, primarily merit, because it's the first of our major system improvements that rides on that infrastructure. But that's also intended to be the service that allows us to have other operational systems running in the future. And so that $12 million O&M is really split half and half between exclusively merit-related costs and then general infrastructure costs that can support multiple systems. Neither Eugene nor I were here at the time merit was actually approved and briefed to the board, but it's my understanding that there wasn't an explicit projection of what those O&M costs would be at the time. It's not unusual for a system development project that's as complex as merit. I mean, that you really do have to figure out, okay, well, how are we going to integrate these various off-the-shelf software packages into, something that we then can support, but, the solution is not always evident at the time that the project is planned. I do believe that the concept was, and this is what's been delivered, is that we would use commercial off-the-shelf software, and like any software that you buy, software companies, have annual licensing fees. That's what makes up a large portion of that operations and maintenance cost.
Great, thanks for your explanation. And again, I certainly support the tenets of merit and just look forward to its continued implementation in our industry. And I'll conclude. I have been such a champion for financial inclusion and really serving the underserved. And I'm very pleased that we will soon be announcing a new director for financial technology and access. Can you all please discuss the two new positions added to this department by the board?
Yes, thank you, Board Member Hood, for that. So as you said, there's two new positions that were added in the final budget that supports the financial technology and access team. These new staff will work with credit unions to harness the opportunities and technological innovations and provide support for financial inclusion efforts to make financial services more accessible to underserved communities. Thank you.
Very well, and I appreciate that, and I look forward to seeing these two new individuals start with us soon. That concludes my comments, Mr. Chairman. I yield back my time, and again, we'll be submitting the additional information for the record.
Absolutely. And thank you for your insistence or request, or perhaps a little bit of both on the FinTech and Access positions. It was an excellent addition, so thank you.
Agree as well on that.
Chairman Hoffman, Vice Chairman Hoffman, do you have a motion?
Sure do. It's a long 7-part motion. I move that the board approve, number one, the 2023 operating budget of $344,158,000 and 1,214 positions, and the 2024 operating budget of $387,588,000 and 1,240 positions. Two, the 2023 capital budget of $11,276,000 and the 2024 capital budget of $11,234,000. Third, the 2023 Share Insurance Fund administrative budget of $4,956,000 and the 2024 Share Insurance Fund administrative budget of $4,354,000. Fourth, that $23,225,000 from unspent prior year operating budgets is available for expenditure in 2023 from the operating fund. Fifth, that $1 million from unspent prior year capital budgets is available for expenditure in 2023 from the operating fund for expenses related to capital projects. Six, that $3.9 million from unspent 2020 operating budget balances and previously made available to pay for rehired credit union examiner annuitants and associated support remains available for expenditure for the same purposes in 2023 and 2024. Finally, seventh, that $15 million of cash in the operating fund be returned to federal credit unions in the form of a credit to the 2023 operating fee schedule as outlined in the board action memorandum.
Is there a second to the motion?
I second.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passes 3-0. The third and final item on our agenda today is proposed rule, parts 701 and 714, financial innovation, loan participation, eligible obligations, and notes of liquidating credit unions. Staff presenting, Nagi Khalid, Credit Division Director, Office of Examination and Insurance, Laura Smith, Senior Credit Specialist, Office of Examination and Insurance, and Ian Morena, Associate General Counsel, Office of General Counsel. And Laura, special welcome to you. I believe this is your first time at the board table.
Welcome.
Nagi, Ian, Laura, you may begin whenever you're ready.
Thank you, Chairman. And good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. Today, Laura Smith and I from the Credit Markets team and Ian Morena from the Office of General Counsel are here to present for the NCUA Board's approval a proposed rulemaking on the topic of expanding access to financial innovation related to credit union engagements and loan participations and the purchase, sale, and pledge of eligible obligations. The proposed rule we are proposing today would amend the NCUA's rule regarding the purchase, sale, and pledge of eligible obligations, including notes of liquidating credit unions, and the NCUA's rules on loan participations and on loans and lines of credit to members. The goal of this proposed rule is to clarify the NCUA's current rules on loan participations and eligible obligations and to provide additional flexibilities to the credit union industry to manage their balance sheets. This includes providing credit unions with expanded abilities to use emerging technologies, such as opportunities offered by the financial technology sector, or otherwise known as FinTech. These changes would address part of one of the strategic objectives of the 2022 NCUA Annual Performance Plan, which is to ensure the NCUA policies and regulations appropriately address emerging and innovative financial technologies. Today, we'll be providing an overview of the key changes and amendments to the proposed rule. But before we discuss the proposed changes, I would like to turn it over to Ian Morena to discuss the statutory background relevant to the proposed changes.
Good morning. Thank you, Nagi. I'll go over a few provisions I'd like to cover in some level of detail. Section 120 of the Federal Credit Union Act provides the NCUA Board with broad authority to issue regulations for the administration of the Act. Section 209 of the Act authorizes the board to prescribe such rules and regulations as it may deem necessary or appropriate to carry out the share insurance provisions of the Federal Credit Union Act and protect safety and soundness of the share insurance fund. Section 206 of the Act provides the board with broad authority to take enforcement actions against federally insured credit unions or institution-affiliated parties that are or have engaged, or the board has reasonable cause to believe are about to engage in an unsafe or unsound practice in conducting the business of credit unions. Congress chose not to define the term unsafe and unsound practices in the Act, leaving the NCUA board broad authority to make determinations regarding which particular practices are unsafe or unsound. So in addition to the general authorities that I've just outlined, the Federal Credit Union Act includes more specific grants of authority to both the NCUA board and to federal credit unions. To the extent there is ambiguity regarding the meaning, scope, and application of these provisions, the board is authorized to interpret the provisions through notice and comment rulemaking. There are three specific grants of authority that I'll highlight in some additional detail. Section 1075, paragraph E of the Act authorizes federal credit unions to engage in participation lending with other credit unions, credit union organizations, or financial organizations, and requires that federal credit unions that originate a loan for which participation arrangements are made must retain an interest of 10% of the face value of the loan. Section 107, paragraph 13 authorizes federal credit unions to purchase, sell, pledge, or discount, or otherwise receive or dispose of, in whole or in part, any eligible obligations of their members. Section 107.13 also authorizes federal credit unions to purchase from any liquidating credit union notes made by individual members of the liquidating credit union, but prohibits such purchases if, upon making the purchase, the aggregate of the unpaid balances of notes purchased under Section 107.13 would exceed 5% of the unimpaired capital and surplus of the credit union. And Section 107, paragraph 14, authorizes federal credit unions to sell all or part of their assets to another credit union, to purchase all or part of the assets of another credit union, and to assume the liabilities of the selling credit union and those of their members. So with all those statutory provisions highlighted, I'll now turn it over to Laura Smith to discuss the changes that are being proposed as part of this rulemaking.
Thank you, Ian. And good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. Over the last several years, the NCUA has modernized and updated several of its regulations to shift from a prescriptive, one-size-fits-all approach in rulemaking to a more principles-based approach. As a result of this effort, many of the agency's regulations are now principles-based, meaning the regulations provide a basic framework for credit unions to determine the best way to structure its operations. This change enables credit unions to establish and adjust their policies to reflect their board of directors' risk tolerance levels, provided those policies continue to meet the principles outlined in the regulation, including safety, soundness, and compliance considerations. The proposed rule would narrow the application of the 5% limit under Section 701.23(b)(4), which indicates that the aggregate of the unpaid balance of eligible obligations purchased under paragraphs B1, B2, II of that section shall not exceed 5% of the unimpaired capital and surplus of the purchaser. The proposed rule would narrow the application of the 5% limit to only notes purchased from a liquidating credit union. Narrowing the 5% limit to apply only to notes purchased from a liquidating credit union would provide federal credit unions greater capacity related to the aggregate amount of the eligible obligations of its members that may be purchased from any source. The proposed rule would also define the term liquidating credit union to be consistent with the terms used in other part of the NCUA's regulations and clarify the specific point in time when a credit union meets the definition of a liquidating credit union for the purposes of the 5% limit in this rule. The term liquidating credit union is used, but not defined in the current rule. Under the proposed rule, the 5% limit would apply only to notes purchased from a liquidating credit union, making it important for examiners federal credit unions to know the specific point in time when a credit union meets the definition of a liquidating credit union. Furthermore, the proposed rule would remove certain prescriptive limitations from the eligible obligations rule related to a federal credit union's purchase of certain non-member loans from other federally insured credit unions. Specifically, the proposed rule would remove the prescriptive requirements in the current eligible obligations rule that a federal credit union must receive a composite CAMELS rating of 1 or 2 for the last 2 full examinations and have maintained a capital classification of well-capitalized under Part 702 of the NCUA regulations for the 6 immediately preceding quarters in order to participate in purchasing and holding certain obligations. Removing those prescriptive CAMELS ratings and capital classification requirements is intended to expand the number of federal credit unions that would be permitted to purchase eligible obligations, thus expanding their ability to better manage balance sheets, liquidity, earnings, interest rates, and better serve the needs of members. To offset the removal of these prescriptive limits and qualifying conditions under the eligible obligations rule, the proposed rule would set forth basic principles-based due diligence, risk assessment, and risk management requirements that must be addressed in a federal credit union's internal loan purchase policy when a federal credit union has or plans to engage in the purchase, sale, or pledge of eligible obligations. The proposed principles-based policy requirements are consistent with the board's longstanding expectations for federal credit unions engaged in the purchase, sale, or pledge of eligible obligations. It's important to note that the proposed broad yet well-defined set of principles would provide federal credit unions with the flexibility to tailor their loan purchase policies commensurate with the size, scope, type, complexity, and level of risk posed by the federal credit union's planned activities related to the purchase, sale, or pledge of eligible obligations. The proposed changes are intended to provide principle-based requirements that are useful for credit unions of any size or complexity to implement the appropriate level of due diligence, risk assessment, and risk management practices without being overly burdensome or restrictive. The proposed rule would also make several changes to the introductory paragraph of the eligible obligations rule to clarify the scope of the rule and align it with the changes being proposed. Since adopting the prefatory language in both the loan participations and eligible obligations rules in 2013, the NCUA has received inquiries from examiners, credit unions, and other parties who have expressed confusion about how to interpret some of these provisions. The NCUA believes this confusion could discourage credit unions from entering into certain types of safe and sound loan participation arrangements and loan purchase and sale arrangements that are within their statutory authority. The proposed change in the introductory paragraph, among other things, are intended to provide clarity and reduce this type of confusion. The proposed rule would also revise the definition of eligible obligations in order to clarify the distinction between transactions treated as loan participations and those transactions treated as eligible obligations under the proposed rule. The definition of eligible obligations would mean a whole loan or part of a loan other than a note held by a liquidating credit union that does not meet the definition of a loan participation under Part 701.22a. The grandfathered purchases provision of the current eligible obligations rule would also be revised to include eligible obligations purchased under the temporary regulatory relief provided in response to the COVID-19 pandemic, and would also include any transactions that were made in compliance with Part 701.23 at the time the transaction was executed, subject to safety and soundness considerations. The proposed rule would also amend the loans and lines of credits to members rule to define the term indirect lending arrangement and indirect leasing arrangement. The new definitions are intended to replace the existing definitions of indirect lending and indirect leasing arrangements in Section 701.23, which would be removed from the eligible obligations rule as part of the revision of the 5% limit. While the existing definition and exclusion of such transactions from the 5% limit would no longer be needed in the eligible obligations rule, the definition of indirect lending arrangements and indirect leasing arrangements is still relevant for the purposes of other provisions of the NCUA's regulations. The proposed rule would also make several changes to the introductory paragraph for the loan participations rule. Similar to changes in the introductory paragraph of the eligible obligations rules, these changes would align the paragraph with the changes made in other provisions of the regulation, clarifying ambiguities and reducing confusion related to the scope and applicability of certain provisions of the loan participations rule. With that, I would like to turn it back over to Ian to discuss changes in the definition of loan participations and the codifications of the 2015 legal opinion into Section 701.22.
Right. Thank you, Laura. So I'll cover that point and then conclude our remarks here. So the proposed rule would amend loan participation rule, Section 701.22, to codify a 2015 NCUA legal opinion letter, which clarifies that an eligible organization can participate out loans that it acquires certain indirect lending arrangements, provided certain conditions are met. To codify the opinion, the proposed rule would add a second clarifying sentence to the definition of originating lender. The second sentence would provide that, for purposes of this section, the term originating lender includes a participant that acquires a loan through an indirect lending arrangement. This is an important clarification because the NCUA's loan participation rule allows federally insured credit unions to purchase loan participation interests from only eligible organizations that were the originating lender. Finally, as we conclude our remarks, as the NCUA board has long recognized, it's important to hear directly from credit unions and other stakeholders directly when the NCUA is making changes to its regulations. This proposal includes a 60-day comment period, which will start on the date of publication in the Federal Register. Thank you for your time today. We are happy to address any questions you may have.
Thank you, everyone, for the excellent presentation. And my thanks go out to the entire team that worked to craft this notice of proposed rulemaking on financial innovation, loan participations, eligible obligations, and notes of liquidating credit unions, which is before us today. For several years now, Board Member Hood has focused intently on how credit unions and fintech companies interact in the marketplace. During his tenure as the NCUA chairman, Board Member Hood led the creation of the NCUA's Office of Financial Technology and Access, and it is also his vision that has paved the way for this rulemaking that we are considering today. Vice Chairman Haltman has also been a strong proponent of this proposed rule and other financial innovation-related policy changes here at the NCUA. And their views closely intersect with my own regulatory philosophy on advancing credit union innovation consistent with our statutory responsibilities. Information technology is found in all aspects of the financial services sector, including credit unions. Even small credit unions rely on technology like websites, core processors, accounting software, and payment systems for their operations. That technology has allowed new actors to emerge in the marketplace to compete with credit unions and banks in traditional areas like consumer lending, mortgages, payments, and business lending. Nevertheless, these actors can also help to offer new partnerships for loan participations and eligible obligation purchases, and new avenues to reach potential members, as well as new sources of liquidity. As I have emphasized before, credit unions should recognize and harness the potential opportunities fintechs may offer them. However, we also must acknowledge the potential risks that these pose for credit unions, their members, and the system, and develop appropriate guardrails. This proposed rule strikes at the appropriate balance in my mind. It provides flexibility, safety, and tailored relief to credit unions while fostering greater innovation. That brings me to my only question for the panel. We are removing the prescriptive language that has been in our regs for more than 40 years, and we are replacing it with a more principle-based approach and new guardrails. However, we've seen instances of credit unions in the past that have failed because they've gotten into trouble through indirect lending and loan participations. Why is this proposed rule sensible at this point in time? And what are the benefits for the NCUA and credit unions under this proposal?
I'll take that, Chairman Harper, and thank you for the question. The approach to the changes in the proposed rule are consistent with the steps the NCUA has taken in recent years to modernize and update several of its regulations to shift from the prescriptive one-size-fits-all approach to a more principles-based approach. The proposed rule would support the agency's continued efforts to strike an appropriate balance between mitigating risks to the National Share Insurance Fund while creating additional opportunities and fostering growth and stability in the credit union industry. Removing and revising these prescriptive requirements in the current rule and replacing them with risk-focused, principles-based requirements will provide federal credit unions more flexibility to customize their loan purchase programs according to their board's established risk limits and better serve the needs of their members. By codifying long-standing governance expectations into the regulation, we are also giving examiners the authority to take the supervisory action when credit unions take excessive risk. In answer to your second question,
Yes.
the proposed changes will also modernize and update existing regulations, which will better clarify the distinction between transactions treated as loan participations and those that are treated as eligible obligations, as well as help identify those transactions where loans are acquired through an indirect lending or indirect leasing arrangements. This will make it clear for credit unions, NCUA field staff, and other parties to understand the agency's rules and how they would apply, especially when a credit union is engaged in a new or an expanded loan program or when partnering with outside parties to enhance service to members. That concludes my remarks.
Laura, thank you so much. So, I mean, really, if I were to go down and drill down, we know that guidance cannot be cited as a document of resolution. It has to be a rule. So we're actually lifting it up, putting it in the rule. So if the credit union is taking excessive risks, we're going to have the ability to act earlier. Do I have that right?
Yes, sir.
Great, thank you. This proposed rule will have a 60-day comment period. During that time, it's essential that we hear from consumer advocates, credit unions, vendors, fintechs, and other stakeholders in the financial service industry that may partner with credit unions in these new relationships. We also need to hear from you about the potential risks of making these regulatory changes and how the NCUA should address these risks in any final rule. We would also appreciate feedback on the unintended consequences of this regulatory change. In sum, I will support this proposed rule. That concludes my comments. Mr. Vice Chairman, you're recognized.
Thank you, Mr. Chairman. Thank you to Lori, Nagy, and Ian for your presentation. It's an ambitious proposal with clarifications to several current regulations. It offers also new flexibilities for federal credit unions to purchase loans of their members from financial technology companies. So my interest in credit union innovation is rooted in the belief that businesses or credit unions must innovate to stay relevant. Plus, credit unions are not top of mind for most fintechs. So anything their regulator can do to improve the process of working with fintechs is critical. At the very least, we do not want fintechs or any service provider choosing not to work with credit unions because their regulator makes it unnecessarily difficult. The NCUA board has a fiduciary duty to make sure we aren't standing in the way of anything that ensures the long-term viability of credit unions. But an issue we face is that credit unions only have about 10% of all of America's insured deposits. The other 90% is at banks insured by the FDIC. The reason that's an issue is that products marketed at banks sometimes need to be tweaked in order for credit unions to utilize them. Banks are 90% of the market, where credit unions are about 10%. Credit unions are the left-handers of the market, if you will. The market focuses on the 90%, not the 10%. Chairman Harper, you're a left-hander. Products that use your hands.
Indeed, I am.
Products that use your hands, are they marketed mostly at the 90% of us who are right-handers or folks like you?
They are marketed for the 90%ers, and I curse every time I get in my car.
So I think that's the frame we need to use when considering the costs and benefits of innovative technology. This is a demonstration of our this agency's desire to improve clarity. We can publish guidance letters and risk appetite statements all we want, but without true regulatory clarity, they're not very useful. This will also help our NCUA field staff as well. I'm going to skip ahead a bit in the interest of time. And just, number one, I want to thank Rodney Hood again for pushing this. And also, for those commenting, please be as specific as possible, especially if you're at a credit union that didn't do as much with loan participations as you wanted to because you were worried about your regulator. It's exactly who we want to hear from. Please walk us through that, okay? And then let's, can you just speak to us like we're children? How does it make it easier to engage in these fintech opportunities for a credit union? How does this rule?
Thank you, Vice Chairman. I will take that question. Taken in combination, the changes in the proposed rule will make it easier for credit unions to take advantage of the technologies and opportunities offered by the fintech sector in various ways. For example, amending the current eligible obligations rule to narrow the application of the 5% limit would provide federal credit unions greater capacity in the aggregate amount of the eligible obligations of its members that could be purchased from any source, including QSOs and fintech companies. Additionally, the proposed amendments are intended to reduce confusion on the application of the loan participation and eligible obligations rules, which may make a difference for those credit unions that were previously hesitant to engage in the programs and lending arrangements with other financial institutions and third parties, including fintech companies, due to the ambiguities that currently exist in these rules. That concludes my remarks.
Gotcha. I just want to note how much smaller the average credit union is than the average bank. It's quite remarkable. The vast majority of ours are under 250 million assets. Some are 50 million. Some of these are run out of like a church basement and they have a single digit number of employees. That's quite common. I want to ask you if you think loan participations might even be more attractive for credit unions because of that. Because a loan participation is when you buy a piece of a loan somebody else made. The reason you might want to do this and not just make that loan in the first place is because you don't have the money to make a loan that big. That's one reason. The second reason is even if you did have that money to make a loan, you might not want that much credit risk from that one borrower, even if you had the cash on hand to make a loan that big. Okay, so I ask you guys, do you think that this general topic of buying a piece of somebody else's loan, would it be more attractive to credit unions? Is there reason to think that because of their smaller size? Anybody can take that.
Yeah, I think for credit unions, and you alluded to it, Vice Chairman Hoffman, especially for smaller institutions that might not have the capacities that larger institutions do, it might be more appealing for institutions like this to be engaged in transactions like this. It is a great balance sheet management tool for an institution of any size, but for institutions that might not have the capacity to underwrite loans to the same extent as larger institutions, correct, it might be attractive to those.
All right, it's useful to buy them and useful to sell them too for
Correct.
balance sheet
Right.
management. That concludes my remarks. Back to Chairman Harper.
Thank you so much. Board Member Hood.
Great, thank you. I want to begin by thanking you, Chairman Harper, for bringing today's rule before the board. And I've said this before, and I'm saying it quite a lot these days. This may very well be the most well-functioning and highly effective NCUA board in quite some time. I think it starts at the top with the chairman and the fact that we all as board members like each other and get along well. And we realize, though, that when we do have policy differences, those are just that, policy differences and nothing at all personal. But just as important, if not more so, for a well-harmonized board is the relationship with the board's senior policy advisors and the chief of staff. And since the board cannot talk to each other directly about policy outside of board meetings, negotiations must be shuffled amongst our chiefs of staff and policy advisors. So I want to thank personally my senior policy advisor, Linwood Brooks. I want to thank Sarah Bang, senior policy advisor to the vice chairman. And of course, chief of staff, Catherine Galicia, for all the hard work that they do each and every day to move this agency forward. So back to the issue at hand. So now I can thank you, Najee and Ian and Laura for your hard work. I also want to let everyone know that this initial work for this rule began early this year with a legal memo drafted by Rachel Ackman, John Brolin, Kevin Taninga, and Ian Marina and Frank Cressman in the Office of General Counsel. I must admit, this was one of the most robust memos I have seen in my career, both in the public and private sectors. It was a very comprehensive memo that was done. The Office of Examination and Insurance also played a pivotal role in developing today's proposed rule. So again, thank you for our presenters this morning, but also I want to thank Simon Herman, Jessica Yam, Vicki Norwal, Amanda Parkhill, Kelly Lay, and E&I for all of your work as well. So I hope I've recognized the hard efforts of everyone who's gone into putting forth today's rule. Today's proposed rule began under this premise. Fintech companies are originating significant numbers of consumer loans. Credit unions want to effectively reach borrowers digitally by utilizing fintech solutions. Are there ways the NCUA could provide additional clarity? The answer is a resounding yes. There are ways, and today's proposed rule is one of those responses. Let me ask a question before moving forward. How large is the loan participation market for credit unions, and how has it grown over the last several years? Any one of you can take that question.
So, Board Member Hood, I'll take that. And thank you for the question. The loan participation market specifically has grown substantially in recent years. The current balance of loan participations purchased across all credit unions totaled $59.7 billion as of September 30th of 2022, which has increased from $20 billion as of December 31st, 2015, which equates to a 16.4% compounded annual growth rate. The growth has especially accelerated in recent years. The loan participations purchased grew by 6.9% during 2019, 12.4% during 2020, 31.5% during 2021, and 20% for the first 3 quarters of 2022. And that concludes my response.
Thank you. That is really helpful, and that really shows that there has been really fulsome engagement with the credit unions regarding loan participations. And to my fellow board members, I would support making any additional changes to the call report that would modernize it even further to address the changes that fintech is rapidly making in our industry. I think this is also imperative for us to have these data points as a safety and soundness regulator. We may be surprised to learn how quickly the industry is evolving with the use of this type of data. Because the industry is rapidly evolving, credit unions need to be exploring how to best integrate fintech tools and partnerships into their business models. In 2022, this is no longer a luxury. It is, in fact, a strategic imperative if we want the credit union industry to remain viable and relevant in the years ahead. To take that a step further, I personally believe if fintech does not fit into the credit union business model, it is a long-term safety and soundness issue for the credit union industry and very well for our agency. Fintech is particularly important when it comes to attracting a new generation of millennial and Gen Z credit union members who are younger, more mobile, and more online. Moreover, I believe fintech can be tremendously beneficial in terms of financial inclusion. So help us extend financial services more broadly to underserved and marginalized communities. So again, it's vitally important that we get this right. And that's why it's so important for the public to send in their comments for today's proposed rule. Credit unions, I believe, are currently losing market share to fintech companies. For example, according to the TransUnion research, fintech loans comprise 41% of all unsecured personal loan balances, up some 5% of outstanding balances since 2013. During that same period, the credit union market share for unsecured personal loan balances declined from 31% in 2013 to 21% in 2021. I understand that fintech lending is beginning to even interest research economists at the Fed, as well as other folks in academia and elsewhere. Preliminary research suggests that fintech lenders are beginning to make significant inroads in mortgage and small business lending at the expense of traditional financial services providers. These loans are mostly to previously underserved borrowers, lower conventional credit scores for consumer loans and zip codes, with higher bankruptcy and unemployment rates for small business loans. Part of this is traceable to creative use of alternative data in loan underwriting. Additionally, a recent paper by the Philadelphia Fed suggests that it may also be due to regulatory burden. I would also note that fintech market share grew even more during the pandemic, which I assume is because of changing consumer behavior. Our NCUA current regulations have prescriptive limits to credit unions being able to compete in this market. And if changes are not made to the regulations, credit unions may never be able to regain their presence in this new normal environment of lending. Today's proposed rule, if enacted as a final rule, would clarify that credit unions that acquired loans through an indirect lending relationship, such as from fintechs, would qualify as the originating lender and be eligible to participate the loan to other institutions in an elegant way. This is important because of one of the biggest and growing sources of loans in the financial marketplace today is fintech-originated loans. Younger, more tech-savvy borrowers and potential members are looking to technology companies to provide their financial needs, and credit unions are getting left behind. Even when a credit union can develop a relationship with a fintech lending provider, they are severely limited in their ability to cultivate this relationship under our current regulations. The current loan purchasing regulations, which today are proposing to change, only allow a credit union to purchase up to 5% of their assets in these types of loans. There are several exceptions to this 5% cap, but they are cumbersome to understand and impose a high regulatory burden. Additionally, it is my understanding that if allowed by state law, state chartered credit unions can acquire non-member loans from eligible organizations. NCUA rules do not speak to state chartered and federally insured credit union loan purchases, so it would only be addressed in state law. The proposed changes before the board today would narrow the application of the 5% limitation of purchasing federal credit unions' unimpaired capital and surplus to only notes purchased from liquidating credit unions, and instead provide for credit unions the ability to establish policies to govern their due diligence and risk management practices regarding these purchases, including establishing their own risk limits based on the size and complexity of its portfolio. I'm a believer in a principles-based approach to regulation. Focusing on the credit decision and who is making it is a deciding factor under the proposed rule. Credit unions will need to justify how they are making the credit decision, which is also implied in today's proposed rule. I like the idea that the onus is on the credit decision and linking it to the origination process. Similarly, this rule will remove the requirement for certain federal credit unions to request NCUA approval to purchase certain non-member loans from other federally insured credit unions. Currently, only credit unions rated a CAMELS 1 or 2 and classified as well capitalized may engage in this activity without prior NCUA approval. These credit unions would now be able to purchase these types of eligible obligations after establishing sound policies, but without having to send in a written request for approval. Some have expressed concern that eliminating the limits in the regulation and the requirement to be a well-run credit union causes safety and soundness concerns. This is particularly important if in this regulation, since a credit union can materially change its balance sheet structure in a very short period of time. I believe we need to eliminate barriers so credit unions can compete. So can one of you now talk about how this risk will be mitigated in the proposed rule?
Yes, I can talk about that. Thank you for the question. To offset the removal of the prescriptive limits and qualifying conditions under the current eligible obligations rule, the proposed rule would set forth basic principles-based due diligence, risk assessment, and risk management requirements that must be addressed in a federal credit union's internal written loan purchase policies when a federal credit union has or plans to engage in the purchase, sale, or pledge of eligible obligations. The proposed due diligence, risk assessment, and risk management policy requirements continue the NCUA's efforts to strike an appropriate balance between mitigating risk to the National Share Insurance Fund and fostering growth in the credit union industry. These requirements continues NCUA's longstanding expectations for federal credit unions that purchase loans to appropriately identify and mitigate undue risk while also providing federal credit unions greater flexibility to establish their own risk tolerance limits. That concludes my response.
Great, thank you, Laura. Well, while we have a clear definition in this proposed rule for loan participations, we say in this rule an eligible obligation is essentially anything else that is not a loan participation. Can you please describe or discuss why it was drafted like this? It's a little confusing.
Board Member Hood, I'm happy to address that, and thanks for highlighting this issue. We actually think it's especially important for credit unions and other stakeholders to give their input on this issue. Nagy mentioned the growth in the loan participation market since 2013, which is when these rules were last substantially amended. So with the growth, there have been a growth in complexity and the number of questions received, and in particular on whether a particular purchase is a loan participation or a partial eligible obligation. So this proposal is attempting to dispel some of that confusion. Both of those transactions are authorized under the Federal Credit Union Act in Section 107. They have slightly different statutory requirements and provisions around them. So the goal of the proposal is to maintain those full authorities in the Act while making some carefully, or we hope carefully crafted changes to the provisions to bring some more clarity. You mentioned the change to eligible obligations, that definition. There are also proposed changes to the introductory paragraphs of both sections on loan participations and eligible obligations. So the goal is to try to clarify the relationship going forward and preserve that authority. But as I noted, that's where it's particularly important to get input from credit unions and other stakeholders in formulating any final rule or any corresponding guidance. So I hope that's helpful.
It's very helpful. Thank you for that very detailed response, Ian. I do, though, worry that this definition may cause some confusion in our examinations. So I would urge that if this rule becomes final as is, additional guidance may benefit our examiners and provide greater clarity and consistency in the credit union industry. The originating lender language in today's proposed rule is important because it closes a blind spot in our regulations. Can one of you please elaborate?
I'd be happy to address that as well. And put quite simply, this will take the 2015 legal opinion letter, which has been out there for nearly 8 years, and codify it in the regulation. And the goal is to provide this clarification in the regulation itself so that a credit union doesn't need to consult the legal opinion letter or contact the Office of General Counsel. That interpretation and guidance will be directly in the regulation itself if the rule is adopted in this format. So that's the anticipated benefit of this proposal.
That's great, and thank you. That's really helpful. You all, I also noticed that a legal agreement needs to be reviewed by counsel according to our rule. Has the NCUA ever considered a template of an approved agreement? I think that uniform legal agreements could really benefit our smaller credit unions and our MDIs and LIQs who may not have a lot of the necessary funds to have this extra level of agreement review.
I'll be happy to try to address that as well. So template agreements or forms were not considered or included in the proposal, but that's something where public feedback comments will absolutely be beneficial to see whether something like that is feasible, and particularly any input on how models or templates could be crafted to try to comply with both federal and state laws that might be applicable to a particular transaction. So I hope that's helpful.
It is very, very helpful. And Mr. Chairman, I am going to be submitting some of my comments for the record, recognizing in the interest of time, so I'm going to wrap up shortly.
Thank you.
I'm delighted that the board is considering this action because, again, I believe this proposed rule will reduce confusion about circumstances when a federal credit union can still be the originating lender when working with fintechs and indirect lending arrangements, which allows the federal credit union to participate loans out, as opposed to circumstances when the federal credit union is simply buying loans when participations are not permitted. If this rule becomes final in its current form, it will no longer require federal credit unions to search for a legal opinion that supplements current regulations to decipher what is permissible in this area. I certainly hope this rule provides more clarity and will be transformative to keep this industry vibrant by using fintech. I'm focused on these reforms because today I'm convinced that they are again essential to ensuring that our credit union industry remains strong now and in the future, because while credit unions have been performing well, we can't stay blind to the competitive pressures credit unions are facing. We must acknowledge the threats that credit unions face from a changing marketplace, the structural restrictions the credit industry has placed upon itself, and a regulatory solution like today's proposed rule that enables credit unions to more effectively compete is something that I certainly want to champion. If we do nothing to respond to the changing marketplace, history will not be kind to this board or this agency. So I view today's action as a positive first step. So again, I'm urging credit unions and the NCUA to be proactive on fintech. And I'll end with a quote from the famed financier, J.P. Morgan, who said that The first step towards getting somewhere is to decide that you're not going to stay where you are. For credit unions in the NCUA, that means that we all need to be pursuing these opportunities. Although I need to be clear, I'm speaking about fintech generally and not any particular product or service. That's my disclaimer. So, thank you, Mr. Chairman, for putting the rule before us today, and thank you for the Herculean effort that went into all the work with OGC and E&I in putting forth the effort. Thank you. That concludes my comments.
Board Member Hood, thank you again for your leadership. Is there a motion?
Yes, Mr. Chairman, there is a motion. I move that the board approve proposed rule parts 701 and 714 of NCUA's rules and regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second?
I second the motion.
There is a sufficient second. All those in favor say aye.
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 All those opposed say nay. Let the record show that the ayes have it, and the motion passes 3-0. Thank you, everyone. That is the end of our agenda today. Before I gavel us out, I do want to recognize the outstanding NCUA team for their hard work this year. Our nation's credit unions remain safe, stable, and strong because of you. And it's hardworking professionals like you who are the greatest asset of the agency. Together, we've had many important accomplishments this year. We finished implementing the merit system after many years of development. We finalized and will soon deploy an information security examination program. We also chartered 4 new credit unions, and we made credit unions' balance sheets stronger by implementing the risk-based capital standards, creating the simplified CECL spreadsheet to assist small credit unions in determining their loss reserves, and facilitating the ability of community development and minority depository institutions to access low-cost, long-term secondary capital through the Treasury Department's ESIF program. To be sure, this list only scratches the surface of the many issues and the time, talent, and energy that everyone in the agency's team has invested to make 2022 a success. So on behalf of the NCUA board and our entire leadership team, I want to express to everyone express our thanks to all who serve on the NCUA team. And looking forward to 2023, we anticipate board action in early 2023 on the interest rate ceiling for loans made by federal credit unions, the 2023 annual performance plan, new field of membership proposals for federal credit unions, and a request for information on climate-related financial risk. In closing, I want to wish everyone a joyous holiday season. There being no further business, we are hereby adjourned.
Here, here. Well done. Thank you. Good meeting.